So we're going to watch this video from Professor G called SCHD Is Killing Me. Is it time to pull the plug? Now, I'm actually really curious to see what he has to say about SCHD because this is one of those ETFs that are incredibly popular in the market. Not in my account, but incredibly popular in the market. And I really want to see what he has to say.
You likely hold a lot of SCHD in your portfolio, or you're at least considering it.
Not me. I don't know about you. In the chat, if you hold SCHD, type SCHD. If you don't hold any SCHD in the chat, put nah, N-A-H, put nah in the chat. I'd actually really like to hear.
So this video is going to be very important for you. About 1/3 of my portfolio is SCHD, so I'm right there with you. There's no doubt that this has been a slow stretch for SCHD over the past 2 years or so. This year it's actually down worse year to date than a bunch of other indexes. SCHD right now is down about negative 2.51%, where year to date S&P 500 is up 2.38%.
Okay, let's do this. What I want to do is a little side by side since you brought it up. We'll do SPY on the left, SCHD on the right, SCHD on the right. Oh, good gravy. Okay. So looking at these two things, right? SCHD looks, oh my gosh, it's even worse. Hang on, let's go to a year to date. All right, year to date, that's SCHD. Oh wait, there's a year to date button down there. Oh, cool, I just learned something. I love when I learn something. Okay, cool. Year to date, SPY on the left. Year to date, SPY on the left. Year to date, SPY, SCHD on the right. This is terrible. This is horrible. This is no good, very bad. Yet, people want to buy. Oh man, I'm excited. I haven't got a chance to really like come down on anything in a while. This is the reason why. If you are buying an equity solely for the dividend income, for the passive dividend income, that is a terrible idea, right? How many years of passive dividend income do you think you need to make up for the fact that the asset price went down? Right? This is equivalent to buying a rent house, watching as the value of the rent house plummets. Right now your rent house, which was once filled with a beautiful family, is now filled with crack dealers. Right? The house itself is terrible. It's a horrible investment, but you're still making rent from the crack dealer. That is the equivalent of what SCHD is doing right now. In no world does it make sense to buy an asset just because it pushes off a dividend without the asset also being in a bullish trend. Now, here's the thing: trends change, right? Man, I saw a YouTube comment earlier that was like, if you're so smart, why were you telling people that AMD wasn't a buy at 100? Look at it now. It's at 146. You're so stupid. Bro, here's the deal. At 100, it just right there, at $100 right here, did it actually turn into a bullish trend? And now that is a great investment. But at $100 over here, as it's crashing down, at $100 on this side, as it's crashing down, we don't know how far it's going to go. Do you know how far it went down? Even further than that? It went down like another 22% from that point. From that point. Only once the 10 was over the 20, prices over the 50, and it started going up, is this a good investment? Now, the reason I brought AMD up is that AMD, while it may or may not pay a dividend, I don't know, I don't really care. Probably not if I had to guess. Only during the time when it's going up in value should you be holding it and taking that dividend income as the gravy on the side, right? This is your Thanksgiving dinner. You just pulled the turkey off the smoker, right? You cut a slice here and you handed it to Nana and Grandpa, right? You handed your slice to Nana and Grandpa, and then your wife comes around the corner. She's doling out a little bit of mashed potatoes. My wife makes the best mashed potato. Your wife can't even come close to my wife's mashed potatoes. I will fight you on this, okay? I don't know what she does other than sprinkle just like goodness, love, and magic into them. But she makes the world's best mashed potatoes. And she comes through and she's like, here's some mashed potatoes, honey. I love you. And then you come around because, you know, you dropped off the turkey. She came through with the mashed potatoes. Now you're coming around and you're putting the, the cranberry sauce. Ooh, I love me some cranberry sauce. I actually really like the cranberry sauce where you pull it out the can. It's still shaped like a can. That's so funny to me. But no, my wife is amazing. And she makes the world's best cranberry sauce as well, right? This is the cranberry sauce to go along with the fact that your trend is a big, beautiful trend. You're rolling in the dough as it's going up and up and up. And if you're getting paid a dividend to go on the side, that's a beautiful cranberry sauce to go with it. However, when you compare that to this, and the only thing you get is some burnt ass turkey, instant mashed potatoes, but you get a little bit of cranberry sauce on the side. Bro, that is the difference in these two investments here. Okay. I would much rather have an investment that pays me no dividends whatsoever because the asset value is increasing significantly. Versus, oh man, freaking camera. Hang on, my camera's moving again. Versus going to an investment that does pay a dividend, but it's losing value on the asset itself. Do we get this, right? Do we get this? Let me know in the chat if you get this by typing get this. Let me know in the chat if you're understanding what I'm trying to say and just type get this in the chat. That'll help me a ton. Then let's continue on with Professor G's video.
And the NASDAQ 100 is up 4.05%. In this video, I'm going to give you some quick highlights as to why it's down so far, and why it's still down while a bunch of other indexes have risen and have actually corrected. I'm also going to give you the actual data and facts and numbers, because most of the time you're only seeing half the picture, especially with a fund like SCHD, so this is going to help in your decision making. Then I'll give you some alternatives to think about, because I want you to build the portfolio that's going to be best for you, and maybe for some of you, SCHD isn't it.
The only portfolio that's best for you is one that's increasing in price, because profits follow price. Okay? If he says anything and it's not in a bullish trend already, it is not what you need to be putting in your portfolio. Just facts.
So long term, let's just build out the best portfolio that's going to be best for you. My name is Nolan Gouveia, my students call me Professor G, and I made this channel to make investing simplified. So here's 3 key reasons as to why SCHD is down. Number 1, that annual reconstitution was just mistimed. The SCHD rebalance occurred on March 21st, 2025 during a turbulent period of tariff uncertainty.
Actually, Arnard nailed this right on the head. I completely agree with you. Let's compare Arnard's SGov versus SCHD. Now, this is going to look weird. I'm going to tell you right now, it's going to look weird. But SGov pays a dividend every month, okay? It goes up in value. You're accumulating that interest per month, and then the dividend gets paid and it resets. Every month it gets paid, it resets. So this is on ultra short-term treasury bills here, 3 months or less, okay? You're getting paid every month, and you're not losing asset value. I don't know when you're getting paid on SCHD. Let's say that you're getting paid SCHD every month, but you're losing asset value, right? One of these has a consistent asset value and it pays you a dividend. The other one pays you a dividend, and it also has market risk associated with this. BJ says, SCHD has not proven to be lucrative at all. Yeah, no joke. Okay, SCHD is quarterly, but point is, SGov kicks backsides. Yeah, for sure.
And market volatility. The fund had to sell out of some defensive names and add others that didn't hold up right away. In Q1 alone, SCHD fell 1.16% versus the S&P 500's 0.36%, primarily due to weak performance in utilities and consumer staples, which make up a large part of its defensive tilt. The second reason why it's down right now all has to do around that energy. The March rebalancing nearly doubled the energy sector exposure from about 12% to about 21%.
Right. And you've introduced a level of market risk, right? Remember, all stocks are bad. Remember this. Write this on your tombstone. All stocks are bad, but every once in a while they act right. If you are buying a bad stock, remember, all of them are bad, just because it pays a dividend, you're going to be losing money. And SCHD has market risk across all these sectors. So not only is it bad on its own, it's bad because it's spreading that risk off in all these different sectors. Now, some of you are probably saying, well, Chris, the diversification, diversification's so much better. But if you're looking for an asset, you don't want diversification. You don't want market risk, right? Equivalent on your house. If your house is for sale, and then the diversification is coming against you, right? everybody else's house now becomes for sale, that's working against you. Okay. But if your house is for sale, you don't have market risk associated with everybody else if you're in your own little bubble. I want you to be in your own little bubble. Okay. Stay in your little bubble. Focus in on what is working for you, what's appreciating in asset value versus having to take everybody else's asset along with it. Yeah. Diversification. Well said, Sylvia.
Introducing greater volatility since energy stocks are cyclical and commodity sensitive. While energy has outperformed earlier this year, sharp fluctuations like oil price dips have weighed on SCHD's defensive profile. Third reason why it's down is probably the biggest and most important for you to understand. This is the T-bill or bond yield comparison. Rising yields on short-term treasury bills.
T-bill comparison. Or we just did that with ESCA versus SCHD. I wonder if he's going there.
And money market instruments have shifted investor preference away from dividend-focused ETFs like SCHD, as these alternatives now offer comparable or higher risk-free yield. So think about it.
That's what we're talking about. Ooh, this is good. Remember, this is a risk-free yield because this is on ultra short treasury bonds, okay? And you're collecting the dividend every month. This is on dividends on the market, which have market risk associated with it. Two different asset classes.
About it. If safety is your goal, if that's the number one thing that you care about at this point, bonds or T-bills or even high-yield savings accounts or money market accounts provide even more stability, which are less risky because they don't have anything to do with the stock market. Equities or stocks just fluctuate so much, and so just inherently, if you're invested within that type of instrument, you're going to see more risk.
Because all stocks are bad.
Right now, if you can get something like 4 to 5% guaranteed through bonds or through T-bills, or even at the high yield savings account or money market account, like I was saying, and you can get basically that through risk-free because it's not going to fluctuate like the stock market, why would you choose SCHD over something like that?
This is exactly what I've been trying to say as well. Exactly. Thank you, Professor G. Now, why did you do that? You've proven my point. Why did you do that in the first place?
A lot of my clients are incredibly wealthy. When you get to a certain point in your portfolio, you care way less about just getting a little bit more growth and way more about wealth preservation. Same thing for these huge institutions and hedge funds. What they're trying to do is make sure and keep their clients safe, but also provide somewhat of cash flow if that's their goal. So if the goal at the end of the day is to get 4 to 5% or so in cash flow, they're going to choose the safest route to do that. And right now that would be like a high yield savings account or money market or whatever it is because the rates are so high. Now down the road, when the Fed starts to bring down the rate and rates just overall drop, now you're going to see things like a 2%, maybe a 1% in your high yield savings account, maybe a 1% in your money market account. Now it's a little bit less attractive for these people to hold money there because if you're only earning 1% interest or something, and statistically and on average, we're seeing inflation of 2 to 3%, it just doesn't make very much sense to hold it there. Then at that point, you do need to increase your risk just a little bit. And the next least risky place to put it would be something like SCHD. And you're getting that cash flow of around 4%. So SCHD being down makes a lot of sense in a lot of different places. The main
Did y'all hear what he said? SCHD being down makes a lot of sense. Am I crazy? My investment going down makes a lot of sense. Maybe I'm just crazy. I don't like to lose money. Apparently, Professor G says it makes a lot of sense.
thing that we need to understand though is this something to continue to invest in or even hold? Long-term, would this be the smart move? SCHD is a fund that's built up of defensive stocks or very boring stocks in nature, which makes it much more stable. It's a value fund with a lower beta than the S&P 500, so it's a defensive play in people's portfolios to keep a well-rounded and disciplined approach. It gives out a nice dividend of 3.5 to 4% on average, and it's a qualified dividend, so it's taxed at long-term capital gains rate, which is much more favorable than income rate. If you're looking to own this fund, you're getting not only one that is appreciated solid for a value fund, but also one who has a very solid dividend growth rate. Plain and simple.
Right. Okay. Dividend growth rate, sure, I can get behind that. Appreciating, I can get behind that when it is appreciating. But that is not now. Remember, we can talk about the AMD example that I mentioned earlier, right? If AMD paid a dividend, I assume it doesn't, This is the time to own it as it's in this beautiful bull run right here. You don't want to own it on its way down. That doesn't help you at all. You're losing 50% of your value all the way down just to collect a couple percent. That makes no sense to me. But if you're holding it and it's gaining 50% of its value and you're collecting dividends on the side, that makes so much sense. We have a huge disagreement here, Professor G. There is no reason to hold on to a declining asset whatsoever. Whatsoever.
You should not be looking for this to be a crazy growth ETF, but you should expect some great long-term results if you're looking to buy and hold. Here are the actual numbers that you need to understand and you need to see. Remember that return and total return are two totally different things. If a fund appreciates, like their price appreciates, goes up by 5%, that's half of the equation. You also need to understand how much was the dividend, or was there a dividend? If a fund goes up 5%, but then it also has a dividend, so you gain a yield of 4%, you take that 5% that it went up, and you take the 4% that you received or that was paid out, and now you got a 9% total return. Because most of us are taking...
Okay. But that's not what's going on in SCHD. That's not what's going on. He's saying you're compounding your gains, right? You're compounding, and that makes sense. That does make sense. But when you zoom out, and this is what it looks like, right? A huge sell-off here. How much is it down? That makes sense to compound your gains by adding dividends on top of it. It's down 11% from its high back in December. Its absolute low, it was down nearly 20%. You're not compounding gains here. No way. You're exacerbating the problem. But on the AMD example, if you're getting paid as it's going up, you are compounding gains. That's awesome. That is exactly what you want. We're not seeing that over here on SCHD today, at least. Now, when it is going up, when it does have the 10/20 price over 50, had a little bit of one right there, then that makes sense. But you're not getting paid on 5 days on a little tiny trend right there.
Taking that 4%, we're not just using it as cash flow, we're usually reinvesting it back into the fund. So you really made a total return of 9% if those were the numbers for that specific fund. When you look at the chart of SCHD, if you just type it in right now and see how it's doing year to date, or even the year to date total that I showed you at the beginning of this video, that's just showing you return or price appreciation. That's not total return. So here's the total return of SCHD each and every year for the life of the fund. So this is found at totalreturns.com, and this is great because this is going to show you everything that I'm going to show you on this here comes from 2011 to literally June 2025. So first and foremost, as of right now, that year-to-date return is a negative 1.39%, which is low.
So you've gone 6 months with no returns. Hold tight real quick. Let's. Oh, this is going to hurt, Professor G. My apologies ahead of time. So I do need to make a tiny change real quick. So we put on all those trades yesterday. We put on 7 trades yesterday. Let me assume that I'm break even on all of them real quick. Let me just assume that I'm break even on all of them real quick. And then we'll take a look at Chris's portfolio for the year. Okay. All right. My win rate's going to be a little bit messed up because in my calculations, it takes into account the expenses. Not much expenses, but the expenses there. So it's going to show very, very small losses on these. Point being, SCHD over the first 6 months of the year, down 1.39%. I'm very happy for you that you've made a couple percent in dividends, and maybe you're slightly above break even. Or you can focus your time and effort on finding stocks that are actually performing, and you could be up over 40% this year. I mean, the choice is yours. You can sit there and hope and pray that it's going to come back for you, or you can be an active trader in the market, understanding what to look for, using those using those bullish trends to your favor, and be up 40% this year, or just around break even. I mean, the choice is yours. You do you. I don't care what you do, but I know what I'm going to do, and it certainly isn't going to be sitting in a dead money for half a year.
Lower than what I showed you, or better than what I showed you at the beginning of this video, because the beginning of this video had just its return, not the total return. Remember that this is SCHD total return chart with dividends reinvested. So the first thing that we can see here is from that 2011 to right now, mid 2025, this is the chart and what it looks like. If we look at the overall return altogether, it's been 388%. And what that actually comes down to is about a 12.4% per year. Remember, this is from 2011 to literally this last month. That's a pretty solid total amount.
For sure, for sure. But imagine, I mean, I could not trade for the rest of the year and be up 3 years compounded compared to SCHD. You choose.
To be gaining every single year on average. Let's look at specifically the annual returns. As you can see here, a lot of green. There's only 4 times that this fund returned negative for the entire year. And one that I want to highlight is this one right here, because this is 2022. In 2022, the S&P 500 went down negative 18%. This one only dropped 3% that year. Right now, it's down 1.39%, which is not fun, but looking at how large each and every other year has gone up and how infrequently this fund is down overall, and then even the total amount that it's down overall, just makes me think that SCHD is just such a solid play at its worst.
Bro. I'm getting frustrated by this video. Dr. J says he's married to the problem. He's okay when it's bad and gives excuses for it being bad. He doesn't know when to cut and run. And this is what he's explaining right here. Right. Oh, Corey was saying earlier, I think the fact that he mentioned it being down makes a lot of sense because of the stuff he's talking about. Okay. I misinterpreted that. That's okay. Jorge says, I think people have been holding SCHD. Oh, wait. Read like the president. I think people have been holding SCHD for a long time, a big, beautiful long time, when Joe Biden was in office, and they don't know what the F they're doing, okay? They don't know what the F they're doing all the time, so they're holding SCHD, right? That's just the end of the story right there. They have no idea what they're doing. Thanks for that. I appreciate it. Now, here's the thing. Is that there are tools out there to help you, okay? Like Corey's asking, what is Outlier? Now, I'm going to give a slight pitch. I'm going to introduce myself real quick and give a slight pitch. But you don't need Outlier, right? You can go onto any stock out there, add 3 itty-bitty baby trend lines, the 10 or 20, price over 50, and know when a bullish trend is happening, okay? Well, there was a bullish trend right here, but trends don't last forever, okay? But keep in mind, you won't make big gains like AMD is showing right here when the 10 got over the 20, price got over the 50, unless you are looking for that opportunity. And sometimes, like here, you might make a buck or lose a buck when that happens. But other times, you can make all the bucks, right? So who am I? I am just a random guy on the internet. So don't listen to anything that I have to say. But my name is Christopher Ewell. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where outliers like us save time, make money, and start winning with less risk together as a team. So go ahead and subscribe if you haven't already. So let's continue off this video here. This video is painful to me.
Worst over this entire time, the worst that it was down is negative 5.5%. I can definitely live with something like that, knowing that the next couple of years was 27, 15, 29%.
Okay, hold on. Professor G, you are an established scholar. Hold tight real quick, right quick. I'm okay with it being down 5% in 2018 because I know the next 3 years it's going to be this, this, and this. Do you actually, bro, Professor G, my friend, I'm probably going to get a lot of YouTube trolls on this one. Professor G, my friend, you have no idea this is gonna frickin' happen. All right, a new moniker. ANI. You have no idea that this is gonna freaking happen. You lying sack of bologna sauce. You can't tell me, oh, it's fine. You know what? It's down 5.5% right now. That's fine. I mean, it's gonna go up, 27, 15, and 29% next year. Who cares? Dude, no. Exactly. What a stupid argument. Bruh. No freaking joke. Don't come at me like that. That actually really irritates me.
And right now, I just want to call attention to that negative 1.39% year to date as of right now. There's so many people.
He's probably saying, he's about to say something like, negative 1.39%? dude, that's nothing. Don't you understand it's going to be up 20%, 19%, and 32% next year? Because that's the argument he just said a moment ago. Professor G, you and I need to have a talk. First off, your hairline is far too nice. I cannot stand the fact that your hair is that nice. Not cool, bro. But second off, you're not a fortune teller, neither am I. Both of us need to be looking at risk first. There's a lot more risk in SCHD than you're willing to let on.
Writing comments whenever I talk about SCHD, saying SCHD is a dog, it's a terrible fund, this thing doesn't ever move. I mean, literally last year it went up over 11%. And right now, in a very bad year for SCHD, where it's doing worse than some of these other funds, it's only down about 1%, and everybody's getting crazy about that. I think we need to have a bit more patience and understand and see the long-term effects. That's why I wanted to show you all those numbers. I even like that it was green and red, so you could just very much visualize.
Exactly. Squatto says, why aren't these ETF advocates expressing any risk management? They always buy back the ETF higher, and it's on a short pullback. It's a disservice. Dude, legitimately, Professor G, to say I am totally cool with it being down, it's going to go up 20% next year, the year and the year after that, and the year after that, and it's going to contract slightly, and it's going to do the same thing over and over and over. You don't actually know that. You don't know that. It sounds fun, sounds sexy, sounds exciting. But in all reality, we don't know where that's going. Yusuf says, I'm down over $600 on SCHD. I used to listen to Professor G hyping it before finding you. I also bought AMD all the way down. Listen, Jeremy, I'm honored and extremely proud to learn. Oh, thanks, Yusuf. That's super kind of you, my friend. If I could super chat back to you, I would super chat right back to you, my friend. You are a rock star. That is super cool. Hey, real quick, let's go ahead and get the elephant out of the room, right? What is Outlier and how does it work? That's what we're talking about today. Well, old Uncle Warren used to say, be fearful when others are greedy and greedy when others are fearful. Outlier shows you if investors are acting rationally fearful or greedy and by how much, allowing you to get into the stock before the outlier move happens. Now, if you're ready to save time, make money, and start winning with less risk, you can do so with just 3 itty-bitty baby steps. First, head over to outlier.com, pick up the annual pass for just literally 82 cents a day. Jorge says 82 cents a day is more profitable without taking any trade than SCHD. Thank you, Jorge. I appreciate that. Or if you're on the monthly pass, you can upgrade from the monthly pass to the annual and save 64% with a single click. Step 2, start using the 9 itty-bitty baby steps that I use to get the slingshot set up here. This is exactly what I use. And the receipts are all over YouTube. I've made over 2,000 videos showing you how to do this, right? You want to be looking at the trend, the signal, and the breadth of the market. You want to be looking at the fear and greed and the breadth of the sector. And then once you get to the stock, the trend, the signal, the fear and greed, and the outlier blocks on the stock itself. Step 3, sit back and relax because you just found the easiest way to save time, make money, and start winning with less risk. Now let's do that. Let's do that exercise, right? It's one thing to talk a big game, Chris. Oh yeah, you talk a big game, Chris. How about we go do that? How about we go do that? Let's run the Outlier 9 on SCHD right now. I legitimately don't know how this is going to go, and I might totally stick my foot in my mouth, but we'll find out real quick, won't we? Okay, I just noticed my little yellow box right here is going to cause a little issue, so let's delete that real quick, and then we're going to do this. Let's go do the Outlier 9 on SCHD. So jump into Outlier, go into the dashboard, and type SCHD. Okay, then pop open another tab because I forgot to do this while I was over there, and we can look at the market real quick. The trend, the signal, and the breadth of the market. The trend of the market, let's go into SPY. Let's go into SPY. Let's zoom in over on the 3-month time frame, just so it's a little easier to see. So we have the 10 over 20, price over 50 with a buy signal right here. Okay, so the trend is bullish, the signal is bullish. The breadth of the market, let's go over to our breadth tab. And let's zoom all the way in. We can see the breadth of the market right now is bullish as well. Okay, cool, got it. Now, the breadth in Outlier is measuring how many buyers sell signals that we see coming through on a daily basis. As this is growing, that means we're getting more and more buy signals. As this is falling, more and more sell signals. Now, let's go to the sector. That's going to be a little bit more difficult with SCHD because it is an ETF. But what's cool about this is this actually gives you an average score of all of these stocks in that sector. So this is actually going to be really handy, right? So we can see here, it's getting less and less greedy. The average of the constituents are getting less greedy more fearful. So that's pretty handy, right? The average of the things inside of SCHD are getting less greedy, more fearful, but they do have more and more buy signals coming through. So you can see the average down here on the market breadth is rolling up. So fear and greed is red, breadth is green. Next, let's look at the let's go through this. The trend, the signal, fear and greed, and outlier blocks on SCHD. So it looks like it was coming down. Let's see, as of today, you got your 10, not quite under the 20. Price is definitely under the 50 on SCHD. That's not a bullish trend. Not a bullish trend at all. Now, the signal, SCHD is sitting on a sell signal. Now, if you are a person who's trying to get the dividends on SCHD, these buy and sell signals probably don't mean much to you. But Outlier has a 68% return just following the buy and sell signals. Only following the buy and sell signals gives you a 68% return. I didn't know what that was going to be. That was a little bit risky to click, but it worked out for me. Now, the signal, that's a sell signal. The fear and greed on SCHD, the index itself, not the average of what's in the index. Maybe I shouldn't say index. I should say ETF. Not the average of the components of the ETF, but the ETF price itself is getting less and less greedy, more and more fearful. So that's bearish. And then any outlier blocks on top of it. Oh yeah, it has an outlier block on top of it as well. So SCHD falls strictly in the neutral category, objectively speaking, in the neutral category for me. That is not what I think is a great investment. I'm only interested if all Outlier 9 is lit up, right? Because that, in my opinion, is the least amount of risk that you can take in the market. But I'm not trying to collect dividends. I'm trying to collect paper, not dividends.
This has been a great fund and very positive for quite some time. I also wanted to show you that there were bad years in there, years where the S&P 500 or other indexes that people are totally fine with did worse than SCHD, way worse than SCHD. Now, past performance doesn't mean future results, but it is good to take the data and just be able to understand that it wasn't just a good period that SCHD did good, it did less bad in bad periods. And I also think that
Okay, well, I guess less bad and bad periods is better than more bad and bad periods. But I'm not putting my money there.
that down the road, if there's ever a year that technology does very bad, if AI just hit that certain threshold and it just has to drop for a little bit because that's the way market cycles go, at that point, everybody's going to be hating on the growth ETFs or even the S&P 500, and everyone's going to love SCHD at that point because it has such minimal technology exposure. So keep that in mind. And I don't want to have to bring out the receipts at that time, but I'm also not above it. All right, so what do we do now? How should we invest? First and foremost, this is your portfolio. You need to figure out what's the most important to you.
I agree completely. I cannot disagree with that whatsoever. If you are looking to put on a trade, an investment, investing and trading to me are synonymous. Trading is just at a lower time frame than investing, but they're the same thing. They are the same thing. Okay. But Chris says, no more. This is painful. But to that point, whenever you come up with a plan, that is your plan. Do not make any trades or any investments without having your plan in place. How should you invest? With Outlier. I didn't say that. Dr. J said that, and he's a doctor.
Do you care about certain cash flow? Do you care about price appreciation overall? Are we talking about a retirement fund versus a brokerage? Do you care about taxes? There's a lot there that you need to figure out. What's your risk profile? How
Taxes are such baloney. Taxes are such an excuse. I hate people talking about taxes. If you are making money, you are going to pay taxes. If you are not making money, you are not going to be paying taxes. I am totally cool with paying taxes because I am totally cool with making money. You do you. You don't want to pay taxes? Fine. Don't be in the market. Don't be a badass trader. You want to pay taxes? That means you're making money. I'm okay with that.
How fast do you need this? Is this long-term or is this short-term? And if it is short-term, if you're looking for something very, very short-term, then I can understand the uproar around saying that SCHD is a terrible fund when it's down 1% in the year. But if you need the money right about now, or if you want something to grow very quickly in the next year, this one maybe isn't the best thing for you. Long-term, this fund has proven itself, and there's a reason why it's a core position in my portfolio. If, though, you care about bigger dividends, if SCHD just isn't appealing to you because the dividend's a little bit too small, then maybe you're going to want to look at some covered call ETFs. The ones that I like best are SPY-I or JEPI, or QQQI or JEPQ. Those are the ones that are most proven in my opinion. There's a bunch out there that do have higher dividends than those, but I'm definitely skeptical on those. Most of them are a yield trap, and you just need to be very careful. If you care more about just absolute safety and you're just looking for the safest thing possible, least amount of risk possible, but still gives you a little bit of cash flow on your money, then why not just do a high yield savings account or money market account or bond, short-term treasury bills, SGov, something like that, where you're going to get 4 to 5% pretty much risk-free. Again, that's a short-term thing because as those rates drop, so will that yield. If you want to focus more on price appreciation and growth right now, then you definitely want some exposure to those higher growing ETFs. At the very least, you want a market average or market weighted ETF, something like the S&P 500 with VOO. But more growth would be things like QQQM, VUG, SCHG, even VGT or SMH if you're looking sector specific for technology and semiconductors. Just know that I hope that you proceed with caution with those. Those are hot right now. Those are great right now. And I do believe that we should all have a piece of that in our portfolio. I'm just worried when I see people say, I'm just going to go 100% growth, and then once it makes a bunch of money, I'll switch it over to dividends. You're just not guaranteed that that's going to 100% work and that you...
Right. But remember what you said earlier, Professor G. This is me talking to you, my friend. You're totally cool with taking a loss this year because the next 3 years are going to go up. You said something very similar to that. This is not a perfect quote, but it's in the ballpark. Risk first, my friend.
You are going to grow. Those are the ones that fluctuate the most. They go up 30%, but they can drop 40%. Just be careful. My personal opinion, the way that I've built my portfolio, and hundreds of my clients are definitely jumping in on this as well, and it's been working very, very solid, would be to build out that 3-fund portfolio and customize it for your risk and your time and just exactly what it is that you need out of your portfolio. To see how to do that best, watch this video here. It's going to go over it in detail.
No, I disagree. Don't watch his videos. If you're ready to save time, make money, and start winning with less risk, click one of my videos instead. Have a fantastic day. I'll talk to y'all soon.